China's unemployment rate estimated to exceed 50%, citizens hope for survival. Xinjiang earthquake, over 4,000 aftershocks, victims unable to return home. Economic downturn, Chinese investors flock to restricted cryptocurrency markets. Chinese pig farms face ongoing losses, pressure persists as CCP opens import of Russian pork. Analysis: Beijing's influence on U.S. Treasuries has weakened. It's all covered in today's China Truths. China's unemployment rate estimated to exceed 50%, citizens hope for survival. The unemployment rate in China is estimated to exceed 50%, as the economic downturn has led to the closure of many factories and stores, causing widespread unemployment. Many individuals are hoping for survival amid the challenging circumstances. A resident from Anhui, using the pseudonym Zhang Lin, shared on January 24 with NTD television that he used to work in Beijing but became unemployed. Afterward, he tried working as a ride-hailing driver for a while last year but faced another round of unemployment due to a lack of business. He mentioned that many migrant workers who became unemployed turned to ride-hailing or food delivery, but with fewer people going out and ordering food, many without work have returned to their hometowns. Zhang Lin from Anhui, many places have closed down, and there are no jobs. Like myself, I am unemployed, and many unemployed people have nothing to do. The economic situation is not good, and many have cut off supplies. Many people cannot survive. Now, the number of people has decreased significantly. In the past, traffic congestion was severe, and buses and subways were crowded. Now, it is all reduced, and more people have either left or passed away. Several citizens from Guangzhou also reported numerous factory closures, including many shops, supermarkets, and stores in large shopping malls closing down. Many street vendors have emerged, but they face strict regulations from urban management. Some citizens estimate that the unemployment rate has exceeded 50%. Mr. Li from Guangzhou, many places have closed down, and people are looking for odd jobs. Among 100 people, about 55 are probably in this situation. You can see many shops for rent on the street. Now, don't expect to do business. It's good enough to survive. Your accumulated virtues determine your blessings. The Economist Intelligence Unit, EIU, has warned in its latest report that China's youth unemployment rate will remain high in 2024, with significant consequences for the economy. The oversupply of recent graduates in the job market, particularly in the manufacturing sector, has led to a drop in wages for newly employed workers. The structural imbalance in the job market, exacerbated by the real estate industry's debt crisis and government policies suppressing the tutoring and real estate sectors, is contributing to persistently high youth unemployment. The report also pointed out that China's working-age population is declining, which may eventually impact the high youth unemployment rate. However, the consequences of the current situation are expected to persist for a long time. Xinjiang earthquake, over 4,000 aftershocks, victims unable to return home. On January 23, a magnitude 7.1 earthquake occurred in Wushe County, Aksu Prefecture, Xinjiang, with a focal depth of 22 kilometers. After the earthquake, houses collapsed and casualties occurred in the area. Among them, all houses in Heki County, Suzhou, Kazil, Xinjiang were damaged. At least 3 people were killed and 4 others were injured. According to the China Seismological Network, from the early morning of January 23 to January 26, there were more than 4,216 aftershocks, with the largest measuring 5.7. On January 26, a magnitude 5.6 earthquake occurred in Wushe County, Xinjiang. A comprehensive analysis by the Xinjiang Seismological Bureau and the China Earthquake Administration Network Center Chamber of Commerce suggests that this earthquake is of the main shock aftershock type, and aftershocks are expected to persist. Residents in the disaster area are strongly advised not to return to damaged houses for the time being to avoid danger. Aman Maimedi, Deputy Director of the Emergency Management Department of the Xinjiang Uyghur Autonomous Region, stated to Chinese media earlier that there is still a possibility of an earthquake around magnitude 6 near the epicenter shortly. Economic downturn, Chinese investors flock to restricted cryptocurrency markets. Dylan Ron, a senior executive in Shanghai's financial industry, shifted some of his funds into cryptocurrencies early in 2023 as he observed a decline in the Chinese economy and stock market. Since the Chinese Communist Party banned cryptocurrency trading and mining in 2021, Run utilized a bank card issued by a small rural bank to purchase cryptocurrencies through gray market traders. Each transaction was limited to 50,000 yuan, about $6,978, to avoid scrutiny. Currently holding approximately 1 million yuan, around $140,000 worth of cryptocurrencies, constituting half of his investment portfolio, Run favors cryptocurrencies over Chinese stocks, which make up only 40% of his portfolio. Similar to Run, an increasing number of Chinese investors are finding ways to hold Bitcoin and other crypto assets, believing them to be safer than investing in the volatile domestic stock and real estate markets. Despite the mainland's ban on cryptocurrencies and strict controls on cross-border capital flows, individuals can still trade Bitcoin and other tokens on cryptocurrency exchanges like OKX and Binance. Investors can also open overseas bank accounts to purchase crypto assets. After Hong Kong officially recognized digital assets last year, Chinese individuals have been utilizing their annual $50,000 foreign exchange quota to transfer funds to cryptocurrency accounts in Hong Kong. According to regulations set by the Chinese authorities, the $50,000 foreign exchange quota is intended for purposes such as overseas travel or education. Financial institutions in China are exploring cryptocurrency-related businesses in Hong Kong due to limited growth opportunities domestically. Despite regulatory challenges, the cryptocurrency market in China has rebounded, with estimated transaction volumes reaching $86.4 billion, and Hong Kong becoming a significant channel for cryptocurrency investments. Physical cryptocurrency exchange stores have emerged in Hong Kong, offering more accessible entry points for investors. For instance, Crypto HK allows customers to purchase cryptocurrencies with a minimum payment of 500 Hong Kong dollars without providing identification documents. The economic challenges in China, including a collapsing property market and underperforming stocks, have led investors to explore alternative assets like Bitcoin, which has seen a 50% surge since mid-October. Observers speculate that the Chinese government may be showing interest in cryptocurrencies, with Hong Kong serving as a potential testing ground for these efforts. Chinese pig farms face ongoing losses. Pressure persists as CCP opens import of Russian pork. On January 25, Aonong Biotechnology Group Company, Limited, a major player in the Fujian pig industry, revealed an increase in the number of judicially frozen and marked shares held by its controlling shareholders, totaling 156 million shares, or nearly 18% of the total share capital. The company disclosed 2 days ago that it had accrued new overdue debt principal and interest amounting to 320 million yuan, approximately $45 million. The cumulative overdue debt now stands at 1.439 billion yuan, around $203 million, constituting 57.45% of the latest audited net assets, and pushing the asset-liability ratio close to 90%. Concerns are rising in the market, speculating that the company may become the second listed pig company to face bankruptcy in this economic cycle. In addition, on the evening of the 24th, Hunan Xinwufeng Company, Limited released its initial performance forecast for the pig sector, anticipating a net profit loss ranging from 1.1 billion to 1.4 billion yuan, around $155 million to $198 million in 2023, marking the largest loss in its 20 years of being listed. According to China Business News, despite 2023 witnessing the second highest national pig supply in the past decade, slow recovery on the consumer side has resulted in low pig prices and prolonged losses for the entire industry. As pork consumption enters the off-season post-New Year, coupled with early investment volume and reproductive sow inventory data, pig prices may remain low in the first quarter of 2024. Data from the Ministry of Agriculture and Rural Affairs of the CCP on January 23 showed that the average price of pork in the national agricultural wholesale market was 19.81 yuan, around $2.80/kg. The persistently sluggish pig prices are pressuring pig companies. Though performance forecasts for 2023 are not yet disclosed, Indications of the year's performance may be gleaned from various companies' monthly pig sales reports for December. Daily Economic News reported an industry insider's calculation, revealing that some pig companies suffered an average loss of over 600 yuan, about $85 per head last year. Based on the average loss per head and slaughter volume last year, the total losses of 10 pig companies, including Muyuan Stock, Wen Stock, New Hope, Tianbang Food, and Shinong Group, may have exceeded 20 billion yuan, or around $2.8 billion. Even Muyuan Company, Limited, known for industry-leading cost control, might experience its first annual net profit loss in 10 years. Amid widespread losses and pressure on China's listed pig companies, the Chinese Communist authorities have opened the door to Russian pork. On January 25, the General Administration of Customs of the Communist Party of China announced the allowance of the import of Russian pork, including edible pig byproducts, that meets relevant requirements. In response, some netizens expressed concerns. Domestic pig farmers have almost lost money in the past few years, and now they are allowed to import Russian pork. How can domestic pig farmers survive? Analysis: Beijing's influence on U.S. Treasuries has weakened. Reuters columnist Jamie McGeever said Beijing's holdings of U.S. bonds look far less powerful than previously thought. In a column published on Thursday, McGeever noted that after navigating the U.S.-China trade war, the impacts of the COVID-19 pandemic, and geopolitical tensions over Ukraine and Taiwan, both the United States and China have substantially reduced their holdings of each other's financial assets. To put it in Washington's terms, both sides are actively de-risking. Tracking bilateral capital flows between China and the United States accurately is challenging due to Chinese companies being listed on non-Chinese exchanges, U.S. investors channeling funds to China through offshore financial centers, and significant differences in liquidity and accessibility between China's A shares and H shares. McGeever wrote, but a broad range of measures suggests that decoupling works both ways. Since 2000, with the influx of investment by U.S. companies and banks in China, coupled with China's significant foreign exchange reserves from exports, these reserves have cycled back into the U.S. market through the People's Bank of China's purchase of U.S. Treasuries. This cycle has created an illusion that any political deadlock disrupting these investment flows would have a devastating blow to the highly integrated global economies of the U.S. and China. However, McGeever argues that this is not the case. According to the latest Treasury International Capital (TIC) report from November 2023, Beijing holds $782 billion in U.S. Treasuries. Although this amount is significant, it is the lowest level in nearly 15 years and a substantial decrease from the peak of $1.3 trillion in 2011 and 2013. McGeever said, more importantly, China's footprint in the U.S. Treasury market is now a fraction of what it used to be. China's holdings of the U.S. Treasuries are less than 3% of the total issued, the lowest amount in 22 years and a significant drop from the record 14% set in 2011. McGeever mentioned that although Beijing may hold U.S. Treasuries through offshore custodians such as Belgium and Luxembourg, its influence on the U.S. Treasury market has diminished. The U.S. Treasury market currently stands at $26 trillion, twice its size 8 years ago and 5 times its size before the collapse of Lehman Brothers in 2008. McGeever also cited signs that outright selling and valuation adjustments are shrinking Chinese government bond portfolios. China's official sector holdings of U.S. Treasuries account for 21% of its foreign currency holdings, the lowest level since 2005 and well below the 2011 peak of 37.5%. According to estimates by Deutsche Bank macro strategist Alan Ruskin, China sold $15 billion in U.S. Treasuries in November, bringing net sales for the past 12 months to $65 billion, confirming Beijing's view of decoupling from key financial links with the U.S. On the other hand, official U.S. quarterly balance of payments data shows that U.S. investors sold a net $1.76 billion of Chinese financial assets in the first 9 months of last year, primarily driven by share sales. In 2022, they sold a net $9.5 billion of Chinese assets, while in 2021, they sold a whopping $67 billion of assets. Both instances were driven by strong equity outflows and occurred during the COVID-19 epidemic in China. U.S. companies have also been withdrawing investment from China. Official data from the U.S. balance of payments show that in the first 9 months of 2023, net investment returned to the U.S. at $5.6 billion, with inflows totaling $12 billion in 2022. Meanwhile, China's foreign direct investment deficit in the third quarter of 2023 was $11.8 billion, marking the first time that China has experienced a foreign direct investment deficit compared with other countries globally. China's foreign direct investment turning negative, according to McGeever, is a marker. Until now, no one knows the extent to which the severe market turmoil China is experiencing is related to the rapid withdrawal of U.S. corporate and bank investment over the past 2 years. Simultaneously, it has been observed that Beijing has had to relax its control over the U.S. Treasury market. As 2024 begins, the financial and economic foundations of the United States and China once again present vastly different scenarios, the S&P 500 index reaching historic highs, U.S. stock markets outperforming Chinese markets, the possibility that the real GDP growth rate of the U.S. in 2023 might surpass that of China, and global funds are flowing into the U.S. from China. McGeever wrote, with the mutual weakening of financial interdependence between the U.S. and China, CCP seems to be the more vulnerable of the two. This is not what everyone foresaw 20 years ago. Don't forget to leave a comment in the section below to share your opinions on today's topic with us. Make sure to like and subscribe to see more interesting topics from China Truths.